Hi everyone, thank you very much for joining us on this episode on crypto regs, looking at what DeFi innovation can do for the existing securities markets. Happy to be joined here by Philipp Pieper, co-founder of Swarm Markets, and Haydn Jones of PwC, who heads up the blockchain and crypto practice there and author of the Executive Guide to Blockchain. So Philipp and Haydn, thank you very much for joining us. You're coming from two totally different perspectives in some ways. If we could just look at, first of all, the benefits of bringing securities onto the blockchain, but also realistically there haven't been so many projects have yet successfully done this. What are the challenges? But firstly, if you could touch on what are the benefits? Why would people be looking to bring securities onto blockchain? Philipp, if you could start with your views there.
Sure. So I think there's a vision of doing digital security tokens, whatever the coin term is. Obviously, that morphs over time. In order to do something else with it, and something else that you can't do in the traditional markets, whether they're private markets or public markets, a lot of the key benefits have been stated to be sort of the fractionalization. It's been sort of the faster execution and single settlement. It's been sort of the 24-hour markets, the sort of governance that you can associate with those kind of digital entities, possibly even the simplicity of distributions of proceeds coming from the underlying asset. A lot of those actually relates to liquidity. And that's been also one of the linchpins actually in this space, where it's effectively, it requires markets to function and be licensed and be able to be executed. I think the issuance side of things actually has been figured out pretty well. So in order to re-up those benefits, I think what's been very clear is that there's a lot of pieces in the chain that have to come together to make them actually really convincingly executed. So I think in theory, a lot of people have been seeing the benefits. In practice, it's been actually sort of a pretty big journey to get to this stage over the past couple of years.
No, thank you. And Haydn, what do you see as the reasons you're seeing some of the companies coming to you looking to bring securities to blockchain?
So it's great to be here. I mean, this technology is transformational in relation to the use case within securities. There are multiple challenges though, and if we look at the sort of the traditional markets, the way the traditional markets issue, trade, and settle, there's lots of structural infrastructure in there that needs to be sort of mapped, if you like, if ever it would get mapped across onto this new platform. So I think there's an expectation that actually it will be nascent new startups that will pick up the torch, if you like, and start to raise capital, debt or equity, or hybrid forms of capital that will then be traded, and that will be issued, traded, and settled on this new technology. And that's well proven. The technology is not an issue. I think that the challenges very much are the need for regulation, the need for some form of emanation of the state to actually underpin reliable settlement. And I say that because, if you look at the way the equities market settles in the United Kingdom, so that's through CREST. The CREST moves money through RTGS, so that's real-time gross settlement, which is run by the Bank of England. The way the UK settles securities is through an emanation of the state. It's through the Bank of England. If we're going to move, if we're going to have wholesale securities markets settling on this technology, there has to be an element of regulation, but there also has to be an element of certainty that it will settle in a way that we expect it to start. We all use electricity, okay? Electricity is great. It works every time we plug the plugs in, okay? But it's regulated, and it's regulated to make sure it's safe and it's consistent. And that's exactly the same sort of mindset we need to have for when we take this technology and we apply it to something like securities.
No, thank you. And you touched on the challenge isn't the technology, right? That the technology exists, we've got it there. Is there still a lot of just misunderstanding or lack of clarity around what blockchain can do and even what DeFi is and what DeFi can do? Is that still one of the main barriers, or are you already seeing some moves towards changing that within companies and having a greater understanding of the technology?
I do think that is that's a point well made. I mean, we speak to the different government stakeholders that obviously oversee this ecosystem, and I always sort of start my conversation with saying, I'm going to use the B word now, which stands for Bitcoin, and then there's always this kind of sort of people going, oh no, okay, here we go. But it's all about Bitcoin, is it? We all know how bad Bitcoin is and all this kind of stuff, and it's like, well, Bitcoin is hugely clever because it brings together store of value, payment, and ledger in one place, and that makes it conditional, right? Because it's all written in code, you see, and that's really clever. That's really, really clever. And I think, we've got to sort of remove a lot of the noise that sits around Bitcoin and just look at it as programmable technology. It's code, okay, that allows us to move value, right? And then what we can do, because it's written in code, we can do really clever things with it and versions of it. Interestingly, there was something like 13,800 cryptocurrencies as of this morning, which is an absolutely shocking number. But that gives you a sense of the amount of creativity in the marketplace in terms of taking this technology and doing clever things with it, such as what we're talking about now.
Just to add to that, I think so once things are digitized, and that's obviously the whole appeal of DeFi and the composability that DeFi gives, it can be actually used in different shapes and forms. You can actually then programmatically sort of, do certain financial functions that normally would need, central intermediaries or trust functions in order to then do something else with it. So the foundation of actually digitizing something that is a security, presents a whole set of conceptual questions that actually a regulator also has to get their mind around. So I think it's been well understood for years now what blockchain can actually do to financial markets. I mean, there's been papers and books being written about this. I think that's not a novelty. I think the fundamental question that regulators have been struggling with is more the question of actually how does that impose itself onto the usual procedures that actually happen in the financial markets that are well-established procedures, and how do new concepts actually then get viewed upon? I mean, there's a very simple question, for example, like what is a private key and what does ownership of that private key mean? And there's been a lot of debate about what that means. And obviously we've seen different rulings on actually what custodianship means in that context. But just from a ownership and responsibility perspective, but also from a tax perspective, it is not a simple concept. So someone then has to, as a regulator, take the leap and say, okay, I'm going to start defining this on the risk that it may be misdefined. But that's a risk worth taking if you're willing as a regulator to then adapt along the way and actually move quickly to then subsequently evolve from there and be quick in actually adapting along the way. Because once that is actually unlocked, once all these elements have been put together well, there's like Haydn was saying, there's the creativity has almost no limits of what you can do with it as a result of it, whether it's from the trading, liquidity, or composability or lending side. And to a lot of regulators' surprise, it might be actually much more transparent and more controllable than actually the traditional financial markets are. But I think it has been a lot. It had a lot of gaps had to be filled in the past couple of years. But we're coming to a point where a lot of those Lego pieces have been now established, both, and this is not technology, Lego pieces on a regulatory side, on a trust side, where the established players are willing to experiment in this field, whether from the regulatory or from the banking side. And now we're coming to a new phase in the market where suddenly these things can actually work together.
Yeah, I think you're right there, that blockchain at least is now more accepted and then almost established as being used for useful information for logistics or storing money or storing value. And we've seen all sorts of industries where that is now the case and even the norm. Where does DeFi come into this, Philipp, in terms of DeFi innovating existing securities markets rather than just storing assets on blockchain?
Yes. So to me, So to me, actually, DeFi obviously has been a buzzword for the last 18 months, but DeFi has been existing before then. So it's not an entirely novel concept. But what's happened in the last 18 months is obviously that certain like lab environments of like decentralized financial applications have been really battle proven, have been sometimes leading to failures and misappropriation. But there's obviously core concepts that started evolving, which are very novel in comparison to how they're used in the financial markets, and that basically have led to a recognition by a lot of players and participants in the market that there's something that the financial markets can really benefit from. And these things evolve around the promise of instant settlement, which we talked about before, but it also evolves around just the transparency of fully collateralized lending. But it also evolves around the whole concept of the versatility in what you can do with these elements and how you can basically run code-based mutual funds if you want to actually sort of consider some portion of DeFi that way. So I think this has very little to do with like Bitcoin, although Bitcoin and related cryptocurrencies are a facilitator of these kind of procedures. But what I was describing is actually now that this has been battle proven in the cryptocurrency landscape and token landscape, actually I think that, or at least that's what we're observing, is that a lot of financial institutions are looking at these procedures and saying, isn't there possibly a way that this can actually change how the financial markets are working? And so how it actually improves the communication amongst financial institutions, how financial institutions can actually productize on their own and maybe actually productize in a mesh across different organizations. And that's where DeFi suddenly becomes something completely different than just a crypto nerd dream, but something that actually really presents a very big revolution for the financial markets infrastructure that these banking institutions and financial and participants are actually communicating with.
Cool. Anything to add, Haydn? You're nodding.
Yeah, I was just thinking about the sort of 25 or so years I spent in different parts of financial services. When I first started, the whole trade life cycle was sort of drummed into us. So you start with a venue, so you've got an exchange, somebody's bought something, you've got trade capture, so that's when it actually gets put in a system. You've got settlements where the securities are delivered in exchange for payment, which incidentally doesn't happen ordinarily simultaneously. And then you've got the back office, and the back office is where we discover that we've sent securities to the wrong depot, or we haven't received payment into the right nostro. So there's this back office cleanup that always goes on as part of the classical securities life cycle. What DeFi offers us, the decentralized finance, and I mentioned this, is the conditional transfer of value. Okay, so if I send one thing, I get something back in return. Okay. Now, in a classic sense, you've got venue, trade capture, settlement, back office cleanup, right? But there's like 4 layers there, and they've all got the same equal and opposite process. But I've got 4 tiers of system, effectively. Okay? Equal and opposite. I'm buying, you need to send me something. I'm going to send you something. So there's a buy and sell between the two of us. DeFi offers us the ability to actually have a single point instance that does all of that. So the transfer of value, provided another condition has been met. Okay. And what it allows us to do, we can create environments and we can spin up these DeFi protocols so that if I sell securities to you, Erica, there's an immediate transfer of value back to me, right? And what we're doing, it gives us this huge, we used to measure cost of trade, one of the big investment banks. And if you think about it, we're sat at the moment, we've reached this floor in settlement costs because of all of the layers of IT infrastructure that have been built. But the ability of DeFi gives us, we can spin up cloud instances of DeFi protocols running on a single shared ledger that records ownership and records the transfer of ownership of securities between parties. And then we can do really clever things because the big headache of sort of trying to calculate withholding tax, right? So if you've ever done withholding tax, okay, so you need to know beneficial owner, you need to know who is the new beneficial owner, you need to know where the residency, and then you need to know the dividend status, and then you need to know when the securities are with or without dividend. and bringing all of those bits of information is a headache for any of these security institutions. So you can do really clever things with drawing out inefficiencies in the process, and running markets that settle 24/7, which I think is a fascinating opportunity.
And even to add to that, Haydn, you were mentioning these layers. There's even the last mile layer, which is then the retail customer or the individual end customer that actually still works through a brokerage house with that market that we're describing with those 4 layers. So in order for actually have a full transparency at any point in time for a regulator or for anyone to actually see like which shares have been collateralized in what kind of lending scenario, that's impossible in the financial markets, really. It really depends on those reportings and reconciliations that Haydn was referring to, which are complicated and take many days to actually then settle. And in this case, there can be that full transparency. There can be that full confidence that whatever you're doing and expecting to be there on the other side is actually there. And then you translate that actually into the regulatory landscape, instead of then for the regulator to actually control 5 different layers with centralized systems, all of which have to make sure that they're actually unbiased and not doing any kind of shenanigans along the way. This actually collapses into one ledger, where you still have to unlock the keys of actually knowing what's actually represented by by whom, so who's identified with what wallet, and who's basically holding the ultimate beneficiary ownership of that wallet. But once that's the case, the regulator has a much more simpler way to look at it. So in my conversations with the regulators, it's been actually the last piece that is mostly a lot of the application process when looking at reportings and how to create reporting systems about what you're doing. Suddenly actually becomes a non-topic, because you can only say, listen, it's all there. It's recorded. You can actually look at it yourself. You can build interfaces yourself. You don't have to rely on me as an actor to give you that information. So, have at it, regulators. So that's a pretty big benefit that actually, number one, it makes the entire regulatory confidence tighter and increases the confidence. Number two, it actually speeds things up quite significantly and makes it less costly ultimately. Now, today we're still in a sort of high cost environment because the procedures are very early, but you can see already very clearly on the horizon that the replication of these legal structures, of the technology structures, of the tie into the financial markets, they'll become very, very cost efficient very soon, and therefore be a very big alternative to the existing procedures.
Just very quickly, because he reminded me of something. So Andy Haldane, former chief economist of the Bank of England, he wrote a paper. It was about 4 or 5 years ago, but he talked effectively, to sort of paraphrase, he talks about fly-by-wire regulation, because if this environment is written in code, I mean, the big thing that pervades code is if-then statements. So if this has happened, then do this, which is obviously how DeFi works. But you see, if a threshold has been exceeded, then do the following. So increase your regulatory capital requirement, for example. So actually, what you can do for the regulator gives us the ability to create a perimeter, an electronic perimeter, has a series of thresholds in there, so something's above or below. And this I think Andy Haldane talked about in his paper. He talks about walking into a big room, and it's a bit like Star Trek, and you've got all of this big dashboard. It's got all these moving dials on it. It's actually 24/7. It's actually tracking the regulatory status of a whole bunch of financial services institutions.
And then the end consumer can actually do something else with it too. So you effectively, a lot of in the traditional markets, everyone who's actually been part of a brokerage, system knows that in order to get into options, you have to answer certain questions. You have to be qualified, whether you have experience using the product, you can assess the risk and so forth. That's a very static perspective. And so if you can bring it into code, like Haydn's rightly referring to, you can not only be more enforcing, you can actually develop a track record of what actually the activity is that justifies you to do certain risk products. But at the same time, you can also gamify that. You can educate people a lot more. So I would say that by basically putting a lot of these tools into the hands of the end decision maker, whether it's a retail or an institutional end decision maker, and making it programmable, you're actually increasing the immediacy of what that product can do, both in terms of the learning as well as in terms of the capability set that actually can then be deployed by that organization, through code.
No, thank you. And maybe we haven't yet seen a vast number of projects looking at tokenizing security, partly because of some of the factors that you've mentioned, cost, partly because of lack of liquidity. Is it just the factors that you've mentioned that costs are getting lower, you've got more users, there's more tools now available to the greater population? Do you see it as inevitable that will become the norm, that we'll be looking at putting all securities on blockchain, or are there any other barriers still?
We've got in the United Kingdom, we've got wonderful, we've got companies like Archax, for example. They're fully regulated as a MTF venue, and that's all very positive. And alongside their compatriots, they're very much leading the way for UK PLC from a securities perspective. I think, and again, this is positive because this is all about regulation. We have a regulatory framework that is paving the way in terms of how these types of institutions can be set up. Liquidity is about volume, and that will trickle through. It's going to take time to build up, and it's a function of increasing confidence in the technology and the settlement protocols. I think we will see a point where there will be broader regulatory capital requirements that are going to be imposed upon institutions, and that again will instill further confidence into the markets. So it's going to take time, but radio was invented 120 odd years ago. It took a while for that to catch on, and you look at everything that we do now is just it's all dependent upon radio telecommunications. So this is we're 20 years into 15 years into this, if you like, think about some of the origins, but it will happen. It's got to happen.
I think we have to look at different categories, right? So, a lot of the visions behind digital securities early on a couple of years ago was about actually sort of, enhancing sort of the crowdfunding for issued, securities. And most of those securities were private securities that then were meant to become sort of semi-public securities by bringing them into the digitized realm. And that had its own challenges, which, actually a lot we talked about is actually about the issuance process, where the confidence, regulatory confidence, what that means, what the expectation by the regulator is, what that means, what are the different categories and transparencies that the underlying issuer has to present, is pretty much, on its path to be figured out. And, technology-wise, it's not a challenge whatsoever to then impose certain restrictions onto the token and what it represents. I think, if you look at like securities in a broader sense, then you basically can also look at, and I think that was what Haydn was mainly referring to, is actually even public securities, right? Most of those private securities will have very low liquidity because they are in some ways just characterized as always dealing with information asymmetries. So in some ways, it doesn't appeal to any kind of investor, and it probably shouldn't also, because they still have some development to go through, a certain stage to reach in the growth process, et cetera, et cetera. But, the next category up is then basically either growth companies, pre-IPO companies, or even going to real public, securities, both in terms of equities and other financial instruments, right? And I think that's actually a lot dependent on trust structures to exist, and those trust structures, how they tie into the proper financial market infrastructure on financial markets as they exist today, and how to make that more efficient, right? Because we've seen different efforts of tokenized stocks out there, starting with sort of synthetic trackers, which actually weren't really sort of asset backed, so they were basically just trying to mimic the value behavior. And then we've seen recently also just sort of tokenized stocks on centralized exchanges were pretty much sort of centralized database entries that were asset backed, but they were sort of not something that was as benefiting from all the benefits that we talked about, like they weren't really something that were programmable because they were basically that one instance on a centralized exchange. And there was certain issues around, certain things there that, sometimes made these offerings then actually be retracted from those venues. But I think, at least what we're observing is that there is a pretty big, demand to test how these public securities can actually be benefiting from that, composability and programmability, while still keeping true to the regulatory requirements. And secondly, there's a very, very big value stream on the blockchain that would benefit from those securities to be there. And that is mostly about stability, actually, so something that is completely, independent from the value of the cryptocurrencies that mostly are establishing the value on blockchain. So we are coming closer to that, but it isn't, as mentioned before, it's not dependent on technology existing. It's more adjacent to sort of, big players becoming comfortable around the counterparties that they're dealing with, big players becoming comfortable around the trust that they're envisioning in this, and basically the whole trading community then looking at that setup that exists and being comfortable around the different procedural steps, both in terms of issuance as well as redemption.
Cool. Thank you. Any final points, Haydn?
Yeah, I think there's two things. I mean, I love what Philipp said there about the tiers beyond the actual settlement life cycle, because absolutely right, because ultimately there's a retail consumer there at some point, there's a big pension fund, there's an insurance fund in there ultimately. But I always like, in our training course, I always like to say, I mean, where does that come from? Well, that's predominantly plastic, so it actually comes from oil, okay? But this technology is a provenance machine. It gives us the ability to step all the way back through the different transactional points and actually look at where things have come from and actually have the evidence to prove that certain things have happened along the way. So it's a provenance machine. Bitcoin is a provenance machine, and these are provenance type problems that we're looking to solve. And then if you then sort of tie that into the statement, which is that the value of a payment in of itself does not add value. The cost of a payment does not add value. So all this infrastructure cost, all of the settlement, all of the cost of trade doesn't add any value at all. So if we can take the cost out, it can only do good for society in general. Whether it's wholesale or retail in context.
Yeah, and maybe to just layer on top of that provenance, I think that's a very, very important concept. And if you really have assets, commodities that basically have some certain complexity around them, and the markets need to evolve around the veracity of something being what it claims to be or not, then obviously blockchain can become a very big platform for that to occur. So you can actually have certain asset elements that claim to have certain data elements that then actually work with different attesters that actually, as an independent organization, can attest that that's true data, so that the entire market actually works with that transparency on a much bigger health, and then can start to value data elements by its own nature. So you can then suddenly have, you don't have to pre-package those products. You don't have to try to simplify that into one packaged thing, but it can also be then markets that then morph over time depending on what investors value in these data elements, right? And you can see this happening in different markets, whether it's from real estate to carbon certificates to other elements, where they are all underlying certain transparency, or they should be. And they're lacking today in the traditional markets the versatility of the platform to reflect that kind of value that is inherently in certain data elements.
Yeah, and we're seeing so many more platforms moving to look at how to use blockchain. So both, thank you so very much, Philipp and Haydn, for joining us and for that interesting discussion. I feel it could go on for much longer. Haydn, you look like bursting to add a final point.
Well, just two things. Always hugely enjoyable to be part of this community. The second thing, I should correct you, because I'm actually co-author of the Executive Guide to Blockchain.
Co-author, I do apologise. I do apologise
for our role in doing this, but otherwise, always a pleasure. And we look forward to curries. Curries are great.
Okay, well, thank you both for joining us.
Thank you.
See you both soon. Thank you. Bye.